And okay, all it's 10:14. Looks like Canvas has indeed closed the quiz. So let me post the quiz grades. And Canvas is being a little slow this morning, as it is every morning. Okay, grades are now posted. Let me download back up the gradebook. And still still a little slow there. Okay, now it is backed up. And finally, let me go back and reveal the answers on the face of the quiz. And it is now done. It's still 10:15, so I have completed all closing activities in 1 minute. Hooray! Okay. Okay, I won't get cocky. I promise. Keep my ego in check. But you should now be able to see everything. And now let me go through the answers to the questions. If you have any kind of business where you are extracting, it's the extraction of natural resources from the ground, then you still have depreciation, but we call it depletion. That's the first question. And if you have intangible assets, you still have depreciation. Things do lose value, but if it's an intangible asset like intellectual property, you call it amortization. Third up, the resale amount, okay, that's the $2, is actually called the residual value. So the answer is residual value. Now, some people say, but I'm reselling it. Well, only certain items are resold. Other items are actually pulled apart and sold for scrap, like in pieces. Other items are actually not resold at all because they're donated to charity, in which case the residual value is actually the tax break, the tax deduction, and not the original amount. In any event, once again, the $2 is called residual value. And it's only in certain circumstances that there actually is a resale of the entire asset in one piece. Okay, last two questions are the numerical questions. I'm going to take this from a verbal sort of common sense perspective. And we're referring back to Louis' purchase of the asset. He buys something for $10. In 4 years, he's going to sell it for $2. And so it's going to lose $2 in value each year for 4 years. It'll lose $8 in total. And so at the end of the first year, it'll be worth 10 minus 2 or 8. The end of the second year, it'll be worth 6. End of the third year, it'll be worth 4. End of the fourth year, it'll be worth 2, which is when he intends to sell it for 2. However, according to that fourth question, 2 years in, there's an assumption that changes. Okay, well, 2 years in, the $10 value has been reduced to 8 and then to 6. So question 4 occurs when the asset is worth 6. Now he thinks he's going to have to throw it away. Uh-oh. So it's now going to depreciate in value from 6 to nothing over the last 2 years that you own it. Well, if something is now depreciating from 6 to nothing over 2 years, now you have to depreciate it by $3 a year. And as a result, the $2 annual depreciation before the assumption change becomes $3. Okay, another year goes by. You're beginning the 4th and final year, or as the question puts it, you're ending the 3rd year. At that moment in time, the asset is worth 3. You don't expect to get anything for it, and therefore you expect to depreciate it by 3 to write it down to nothing. Now you find out another assumption change that at the end of that final year, you'll sell it for 1. Well then, if you're beginning the year and it's worth 3, and now you are thinking, I'm going to sell it for 1 at the end of the year, the depreciation during the year will be 3 minus 1, or 2. Okay, any questions about that? Or any questions about the quiz in general? Going once? Going twice? And okay, so that concludes yet another quiz. We are getting there. At this point, 5 weeks to go. Now, let me talk to you a little bit, or basically remind you, if you will, what we have in store for next week. Hold on just a bit, because I am going to share screen. Seems like a good idea. Okay. Well, I was saying that Canvas is sluggish. Actually, I still think it's sluggish, but Zoom might be sluggish too, and it might have something to do with the horrible weather. I am now sharing screen. There's the textbook, which we're about to review. Just as a reminder, though, on Tuesday next week, we will take a quiz on the remainder of Chapter 11, which I've already highlighted in yellow here, and which we'll review in the first half of the remaining period of class that we have today. We'll take that quiz from 10:02 to 10:14, our usual time. I actually will go ahead and, post the answers, post your quiz grades, download the grade book in the next 6 minutes from 10:14 to 10:20. But I won't actually review the answers to that first quiz, because at 10:20, or specifically from 10:20 to 10:32, we'll take a second quiz only on illustrations 18.1 and 18.2. Please keep in mind, I'm going to cover this 2 different ways. Number 1, I will discuss it with you, but in a somewhat more light way than I have with other chapters, because between now and Tuesday next week, I'd like you to watch this video. Okay, we are entering the video era. We're entering late 20th century technology. Hooray! I guess we're moving in the right direction. This is a video that I created, that I recorded, and the idea here is if I sit down and say, let me just take 16 minutes and create the perfect video, which is not exactly the same as let me record what I am saying to you live on the fly. And if I can make the video that I'm recording brief enough and effective enough and to the point enough, then this could actually take the place of some time that you might otherwise spend reading the textbook or simply trying to deal with a little bit of confusion, and it could be helpful in a supplemental way. And so on Tuesday next week, first we'll take the quiz on the remainder of chapter 11, which we'll cover right now in our normal way. Then we'll take a quiz on the first two illustrations of chapter 18, which will cover both what we are doing in class in the second half of this class in a light way. The quiz will also cover what I recorded on the video, which you now see on the screen there. If this works, then I'll continue to move in this direction. Your feedback in whatever way you want to give it to me, whether it's an email message afterwards, sticking around for a few minutes after a particular class, whatever method that you'd like to chat with me in, is perfectly okay. Your feedback is definitely helpful, always helpful. One other thing I just want to point out, just the fact that you're looking at this is not right. Now, what do I mean by that? Well, I am not logged into Zoom at all. I am not logged into the university system at all. I am not on the university's campus. I'm in my home office right now. And I do not have any university app loaded on this laptop computer. I should not be able to click on a link on a document on my hard drive and see a video that is locked within the copyrighted protection of Canvas. And I'll just play the first moment so that you can see it's a live video. Hello. Okay, it's a live video. And actually what I'm doing right now is displaying copyrighted information, which Canvas should be preventing me from showing you. That's the purpose of the walled garden of Campus, and yet it's happening anyway. This is why I'm moving so slowly and so deliberately in terms of picking up or advancing these newer technologies. I don't want to get into a situation where I know I'm doing something that technically isn't right, but I have not gotten approval in advance. And suddenly the system raises a huge red flag somewhere, and we just lose whatever it is that we've been doing. Stuff like that can happen. So anyway, when you click on the link down here, whether or not you have been, whether or not you are logged in, to Canvas, whether or not you have the Canvas app, et cetera, you will be able to watch the video. No, it's not right. Yes, I have full permission to do it, so it's no problem at all. Okay, questions about what we have in mind for Tuesday next week and why? And okay, will this be helpful? Will it not matter much one way or the other? Or will it actually be counterproductive? The only way to tell is to give it a shot and see what happens. But please keep in mind, I've picked chapter 18 because I do believe that it is basically the material which is most conducive to be taught or supplemented in a video perspective. It is, again, I don't want to say it's simple because nothing is simple, but it is relatively straightforward. As we'll see when I review it in a relatively light way in approximately 30 minutes or so, give or take. Okay, so with that in mind, let me shut down Safari. Let me close this for the moment. Let's review the last elements of chapter 11. 11-19, which is right here. It's an illustration called error correction. Sometimes the author writes things, as you probably noticed, that just makes me laugh or shake my head a bit. The author has this slightly unusual side comment. It's like the author is thinking aloud and you happen to be eavesdropping on his thoughts. Sometimes this analysis is easier if you recreate the entries actually recorded and those that would have been recorded, and then compare them. Well, number one, there was no reason for him to write that because that's exactly what's happening in the illustration. In the illustration, he writes, should have been recorded, and then recorded. So the blue stream of consciousness thought doesn't really add anything. Also, number two, it's not really a matter of saying sometimes. You need to do this all the time to correct an error, or else you won't know what to do. And so this is a situation, and by the way, what I usually do is, and this is just the way my brain is wired, I begin by saying, okay, what actually happened? And then I say, what should happen? What should have happened? And then finally I say, how do I change what actually happened to what should have happened? And because my mind goes in that sequence, what actually happened, which is here on the right, I usually put on the left. What should have happened, which is here on the left, I then put on the right. Although I do know people who come from cultures where you naturally read right to left, and they tend to say at this illustration, no, Mike, this is actually, for a change, exactly the way that I think, because I read right to left. In any event, whichever way you're reading, whichever way that you're putting the columns, the logic is, step one, what did I actually do? Step two, what should I have done? And then step three, which is the journal entry you make, let me change what I did to what I should have done to put it right, so to speak. So, looks like you spent $300,000 to create a patent, which is intellectual property. It's an asset. Instead of debiting or creating the asset for 300, you just expensed the 300. Well, that's wrong. So you would think, okay, I should have created or increased or debited an asset for 300. Let me create the asset for 300 now. Maybe I should, well, the reduction of cash of 300 was actually the right thing to do because I spent 300. It was the debit to expense of 300 that was wrong. So you might be thinking, maybe I should reverse the debit to the expense account of 300 by crediting expense for 300, and then maybe I should debit the asset called patent, which I should have done anyway. That actually would be true, but there's a twist, which is to say, you actually made this mistake more than a year ago, in a prior year, which means that the $300,000 expense that you erroneously debited is no longer sitting in your legal fee expense account. Why? Because at the end of every year, expenses are swept into retained earnings. And so you really do want to credit expense, debit the asset by 300. But if the old expense is now sitting this year in retained earnings, you credit retained earnings, which is where the expense is now, and debit the asset. One more thing. Why aren't I debiting the asset for 300? Because it has depreciated since the time that you made the mistake to begin with. In the years that have passed, the $300,000 asset has depreciated to 180. And so one way or the other, you need to have a $180,000 asset on your books. That's what it's worth. Debit asset, credit expense. Well, only if it was an error that you made in the current year. Credit instead retained earnings, because that's where the prior year erroneous expense got swept to. Okay, so there's a lot of strange little moving parts in this illustration. But the bottom line is, when you make a mistake, you think about what you did do. You think about what you should have done, and then you correct the error. In this case, the error is the return of an asset or the recording of the asset for the first time on your books. So the debit is going to be to whatever the asset is worth, 180. You are tempted, therefore, to credit revenue or expense, but because this was a previous year error, and previous year revenues and expenses have been swept into retained earnings, the credit is to retained earnings. Question about illustration 1119. Okay, 1120. Impairment. If something is impaired, that means it's operating at less than peak efficiency, right? If you are, let's say, hearing impaired, if you can't hear well, that means that your ears, your hearing is working at less than peak efficiency, or your ears are working at less than full value, in a sense. Well, assets become impaired as well. And usually, when you know an asset has lost its value, you ask yourself, is this just sort of a temporary thing, or is the asset permanently damaged, permanently lost its value? And if the answer is, no, this is not just a temporary thing, it has permanently lost its value, then what you want to do, what you need to do, is reduce the value of the asset to what it is now worth. So here we have an asset whose book value or accounting value is 170, but it's now only worth 135. So it's lost 35 in value. As a result, you reduce the value of the asset by 35, which reduces the value of the company, which is recorded as an expense or a loss of 35. And you might think, okay, Mike, but you highlighted those last two lines of the journal entry and you said assets are going down by 35. I see two lines there, and neither one of those is 35. That's because the textbook author is just in love with the concept of using these contra asset accounts. So if instead of having one asset on your books that's worth 170, you have two assets, one worth 300 and one worth negative 130, then the reduction in the asset value of 35 can be booked against the original cost column of your database. It can be booked against the contra asset column. It can be booked against a combination of both columns in some way. And it doesn't really matter. The bottom line is what's really happening in this journal entry is you're reducing the value of the asset by 35, and you're recognizing an expense, or as the author puts it, a loss, because when an asset declines in value by 35, the value of the company declines by 35. Okay, questions. Okay. The author really goes into a lot of detail, which I just don't think is helpful. So what I just said means that something must have changed, change in circumstances, as the author puts it, to reduce the value of the asset. Then you needed to, let's see, recoverability test. That's the author's way of saying, is this a permanent thing? Or is it only a temporary loss of value? You know, a bad storm hits and something blows over and is slightly damaged, but it's disconnected. And so you have to reconnect the asset to make it work again. Well, in that moment when the storm blew your asset over and you can't use it in that moment, you might say, I've lost its value. But if all you need to do is put it up on its feet or legs and plug it back in, and suddenly it's good again, there's no point in writing it down on your books. You just pick it up and plug it back in. And so the ability to pick it up and plug it back in is what the author calls almost sanctimoniously a recoverability test. Okay, that's what you call it. That's okay with me. And then finally, if you determine, no, this thing has lost a chunk of its value, it's not going to recover. I'm not going to be able to just plug it back in. Well, then you record the journal entry of the expense or loss. Okay, questions about illustration 1120? Okay. 1122, goodwill. This is just sort of the beginning. We just touch upon this in this class, but it's, in my opinion, one of the most interesting topics in accounting. It's just that we primarily cover it in advanced financial accounting, which UH teaches at the graduate level. It's not an undergraduate class, or not required as an undergraduate class, I don't think, towards the degree. Okay, so what's goodwill all about? Well, if I see a company that's worth $8, and if I pay $10 for the company, the question is, why did you buy $10 for a company, or pay $10 for a company that's only worth 8? Now, sometimes I just overpaid, which of course is a problem, in which case there is no goodwill. This is not relevant. But sometimes I say, I really do think that the company has a positive reputation. There is some brand value. There is some goodwill in the minds of the customers regarding the company. And the company never bothered to recording it. And since the company never bothered recording it, the $8 value of the company excludes the value of goodwill, which is an asset. But I think there is goodwill in the company, and I think it is an asset, and I think it's worth $2. And therefore, I think the company was worth $10 in total. That's why I paid 10. Okay, well, that makes perfect sense. But the funny thing about an asset like goodwill, you can lose it awfully quick. You do one stupid thing, and suddenly people are not in love with you anymore. And so, if you do have an asset on your books called goodwill, you have to continually ask yourself, is the value still there? Or have I been doing stupid things lately to make the value decline? And there's all kinds of different ways to compute it. Most of it is actually, the kind of thing that you will learn in advanced accounting. But the bottom line is, if you have recorded goodwill for that reason on your books because you paid a certain amount for a company and one of the assets that you are actually paying for is goodwill. If goodwill then loses value, then you reduce the value of goodwill, the asset, to what it's worth. That reduces the value of the company, and thus you must record a loss or an expense on the loss in value or the impairment of goodwill. Final point. You will sometimes see goodwill continue to be calculated or estimated as the fair value of a company versus the book value of the net assets of the company. What does that mean? Well, the fair value of the company includes or excludes the value of goodwill. The book value of the company, likewise, might either include or exclude the value of goodwill. And it's just really important to know whether each of those numbers includes or excludes the value of goodwill. Here, okay, what seems to be happening is the book value of the net assets of the company includes the value of goodwill. It's the value overall of what you bought. The fair value of the company also includes the value of goodwill. It's the value of everything that you bought. Well, what's happening here, and the textbook author doesn't really describe this in a way that I think is understandable. What happened here was you bought a company for 440 and someone asked you, why'd you pay so much? It doesn't seem like it's worth 440. And you said the company has a ton of goodwill. And so you put all the company's assets and liabilities and a whole bunch of goodwill on your balance sheet when you bought the company. Then you said, what is the value of the company now? 360. Uh-oh. Did the value of the company come down because the company is poorly run? Or did the value of the company come down not because it's poorly run per se, but because it's lost goodwill, it's lost brand value? And by the way, you could lose brand value even though your company is well run. It could be that someone else in your industry did something incredibly stupid, and then you get punished for it. When BP had the Deepwater Horizon catastrophic oil spill in the Gulf of Mexico, ExxonMobil's goodwill was impaired. And ExxonMobil said, what did I do? That was BP's problem. And the answer is, in that moment, nobody trusts any oil company. And so all the other oil companies, including ExxonMobil, saw a reduction in their goodwill value as well. And so I think what's happening here, kind of hard to say, is that both of these numbers, the 360 and the 440, include the value of goodwill, that the market value of the company has declined from 440 to 360. And we are to assume that that is because the goodwill of the company, that the value of that asset has declined. How do I know that? Because in the journal entry, we're reducing the value of the asset by 80. Okay, questions about this illustration? Any questions? Okay, so let's go on to the last illustration, chapter 11. It's in part C, subsequent expenditures. It's illustration 1126. There we go. So what's happening here? We have an air conditioning system. It's worth $40,000. Now, the textbook author doesn't just have an asset called air conditioning system worth 40. He has an asset worth 200 and a contra asset for depreciation worth negative 160. But if you take the asset that's worth 200, and if you take the contra asset for depreciation, loss of value, negative 160, we're dealing with an air conditioning system that is worth 40. And two different things are happening. We're ripping the air conditioning system out of the building, and we're not reselling the entire system, but we're pulling it apart and selling it for parts. We're not going to get $40,000 for it, but we'll get $12,000 cash for the parts. Then we're buying a new air conditioning system for $230. Okay. Alternative one is, in my opinion, the thing you should do. You should say, there are really two things happening here. Step one, I am selling the old $40,000 system for $12,000. Remove or credit old asset, $40,000. Add new asset, cash, for $12,000. Well, if you sell one asset goes down in value by 40. And if another asset goes up in value by 12, then assets overall have decreased by 28. Value of the company has decreased by 28. You have an expense or a loss of 28. And you see that happening here in this first journal entry. It's a little tricky because if you were just using one asset account called building that was worth 40, you would see a credit to building of 40. Instead, the textbook author has a $200 asset and a $160 contra asset. He's still removing them. You are still reducing building assets by 40, but you have to remove these two accounts, not just one. You do still see cash going up by 12. And therefore, the reduction in the value of the firm, the debit to expense or loss, is 28. That's the first thing that happens. The purchase of the new air conditioning unit for $230, that's the second journal entry. It follows the first entry, but technically it's something different that is happening. Reduce cash, increase building by 230. Any questions about alternative one? It's the one that I think is the right way to do it. Now, alternative two says, maybe we should think more holistically. Do we really have two different transactions? Or is this just one big, complicated transaction? I mean, we're spending 230, we're partially offsetting that expenditure by selling some old pots and getting back 12. So realistically, the cash that we're spending net is 218, right? We're spending 230, but we're getting back 12,000 of cash. So really we're only spending net 218 of cash. And yeah, you can go through the details of there's the new system, there's the old system, there's the pots, etc. But basically, as far as I can see, we're spending $218,000 to upgrade the building. And so maybe we should just say, alternative two, we're spending $218,000 to increase the value of the building. And that's it. Alternative one picks apart the two transactions and thinks of them as different transactions. Alternative number two is a little bit more of the lazy person's approach, because a lazy person will say, I don't want to be bothered with the details. All I know is after this stuff happens, I'm $218,000 poorer, but I have a more valuable building. So don't bother me with the details. Let's just increase the value of the building by 218. Which is right? I actually think alternative one is right, but it almost doesn't matter because ultimately you should be thinking about the value of the building from time to time. And if the value goes up, you should increase the asset value. And if the value goes down, you should decrease the asset value. So ultimately, you're going to record the value of the building to whatever it happens to be worth in any particular moment. This is basically just a way of saying, if you're spending $218,000 net, what's the journal entry that I book at the moment that I spend that cash? In my opinion, a good accountant peels apart all of the details, gets to know what the details are, and an understanding that in a detailed way, there are really two different things that are happening. That's just being a good accountant in my book. But the textbook author points out, and I can't argue this fact, there are a lot of lazy accountants out there who say, don't bother me about the details. I'm spending net 218, at least in the moment. I presume the value of the building is going up by 218. Okay, now alternative three is not really a different alternative. What the textbook author is reminding us is, if I want to increase the value of the building, and if I've made a choice to use a contra asset account as part of the value of the building, I could increase the value of the building overall by increasing the positive asset called building, or I could increase the value of the asset overall by reducing the negativity of the contra asset. This is exactly why I haven't at all been giving you a hard time about whether or not to use a contra asset account. And when you want to adjust the value of the asset, whether to adjust the original asset or the contra asset. As you can see here, the textbook author is saying either alternative, 2 or 3, is equally okay. Okay, questions about illustration 1126? Okay, so let me ask more broadly, questions about chapter 11 and all of these illustrations in general? Going once, going twice, and we're good. Well, I was hoping to get to this point at exactly 11 a.m. It looks like we're 1 minute early, so that's that's a good thing. So let's take just a brief momentary deep breath of a pause. Phew, okay, because we're about to jump to chapter 18. Once again, keep in mind the way in which I am covering illustrations 1 and 2 is going to be light because of the presumption that you're also getting reinforcement by watching this video. Also keep in mind that even though illustrations 18.1 and 18.2 are just 2 illustrations, they are actually very comprehensive and very informative illustrations. And so even though I seem to be covering less in part A than I will cover in parts B and part C, realistically, these 2 illustrations in part A are probably as important and as voluminous, if you will, than all the other illustrations combined. Okay, so 18.1 and 18.2. First, keep in mind, we are talking about equity. The value of everything that we own, which is our assets, minus the value of everything that we owe, that's our liabilities, equals our value, also known as equity value, what the textbook author calls shareholders' equity. That's actually what we began the very first lesson of our class talking about. And so we're sort of coming full circle at this point as we come close to heading into the final month of the semester. We're circling back and we're talking about the value accounts in equity value. Okay, so which equity accounts do we have in our database? Generally speaking, up to now, we've been talking about 3. We've been referring to an account that we've called stock and an account that we've called revenue and an account that we've called expense. And that has pretty much been it. So they're all here. And as you can see, we have 3,000 in assets and 1,000 in liabilities. Then the value of our company, total equity value, 3 minus 1 equals 2. So stock and revenue and expenses up to now have been what we have been keeping track of, which should appear on this chart in this illustration. Where are they? Well, common stock is stock. The reason why you don't see revenues and expenses listed is because, actually, as we've said earlier today, the end of every period, revenues and expenses get swept into retained earnings. So revenues and expenses are actually here in this illustration. They are simply in retained earnings. What's all this other stuff? Well, they're variations and elaborations on the same themes. What if you have sold two different types of stock? And let's say one of the two types of stock you sold for more money because you tell the people who are buying that stock, I prefer you to those other people, the commoners who have only bought common stock. And because I prefer you, you should give me more money for my stock. Well, those investors will say, okay, I'm happy that you're preferring me, but is there anything else that I get if you're going to charge me more for the stock? And the answer is usually that preferred shareholders will get paid dividends before common shareholders do. So if I have a share of preferred stock, and if you have a share of common stock, and we each only have one stock, and the company says, I want to pay dividends, but I only have enough money to pay one person dividends, I will get the money, you will not. Now, once the company says, hey, good news, I have enough money to pay two people dividends, well, I'll still get my dividend first because I'm preferred, but then you'll get yours. Depending on how much money the company has to pay dividends, either it'll be only the preferred party who gets paid, or it'll be both, the preferred party and the common party, if you will. But the preferred party gets paid first, and in exchange, the preferred party will pay more for the stock to begin with. Any questions about that? Okay. Now, when you first go to sell stock, your lawyer will say, hold on. You can't just like write up a little stock certificate and sell it. You have to register the stock that you're about to sell with the government. And if you're on a stock exchange, with the stock exchange. I remember when I founded my first consulting firm and I incorporated, and I was the only owner. Well, my wife and I were joint owners. And I went to incorporate and it said, how many shares of stock will your company have? And I wrote, one. And it said, you can't have one, minimum 100. And I said, okay, then I will issue myself and my wife 100 shares, right? And then it said, how much is each share worth? And I wrote, I have no idea. And of course, it rejected that explanation. And it said, if you have no idea, you have to put some number down. Just put a small and simple number down as your first guess. And so I literally wrote $1. The registration value that you tell the government, and if you're publicly traded, your exchange that you're worth, when you first apply for the right to sell stock, that registration value is called the par value. And in theory, it's supposed to be what you think the stock is worth. But very, very often, more often than not, you really don't know. And when you don't know, it's perfectly legitimate for the government or the stock exchange or both to say to you, just pick a small, simple number and put it in. And then you're always welcome to change it over time if you want, but you don't have to. That's what par means. Now, what happens if the company has one share of stock that it's selling for $1? And let's say it gets $1 when it sells the stock. It will increase cash by $1, increase stock or common stock by $1. That's what we already knew. What if a stock is valued at $1 par, but the company manages to sell it for $1.50? Well, the debit to cash will be for $1.50. But the stock, you've told the government, has a $1 par. It's worth. So you'll increase the equity value column on your data set by $1. Well, hold on. Cash is going up by $1.50. The equity dollar column, common stock, is going up by $1. Doesn't that mean that the company is really going up in value by an additional 50 cents somewhere? Yes. And so we need a second value column called additional paid-in capital. And in this case, it would be additional paid-in capital because of the sale of common stock where the money that we received exceeded par value. Debit cash, in my example, $1.50. You're rarely increasing the value of the company by $1.50. But because the registered value of the stock in that moment is $1, you credit registered par value of stock by $1, and then you credit additional paid-in capital, additional value received by selling stock for $1.50. That second credit will be for 50 cents. And as you can see, every time that you want to sell something that needs to be registered with the government, if there is a chance, as there usually is, that you're able to get more than the registered value when you sell it, whether it's preferred stock, common stock, bonds, stock options, whatever it is, then the odds are pretty good that you'll need this additional paid-in capital account in the equity value section of your general ledger. So we have one or two other sections here. Before I go into them, any questions about what I just went through? Okay. What is other comprehensive income? It's just like net income, but it's net income for unusual or sometimes downright weird revenues and expenses. So let's say I'm running a small food truck. But as a company that has a food truck, I will occasionally take my earnings and invest them in, let's say I'm investing them in cryptocurrencies. Why would a food truck want to do it? Well, I wouldn't advise it, but some food trucks do it. It's not illegal. And so what if the food truck owner invests money in cryptocurrencies and on the investment either gains money or loses money, revenues or expenses? Well, that's weird. That's unusual for a food truck. And therefore, we might say, let's not just bury it in normal expenses where it gets dumped into retained earnings. That's unusual. we should highlight that and track that separately. And so it's just like revenues and expenses, but we call it other comprehensive income. And at the end of the year, whereas revenues and expenses get swept into retained earnings, other comprehensive income gets swept into something that is really similar to retained earnings, but for unusual revenues and expenses, accumulated other comprehensive income. You will also sometimes see other comprehensive income abbreviated as OCI. And this, and like the full phrase, abbreviated as AOCI. Other unusual gains or losses that would go in here, if the food truck has a pension plan, and if the investments in the pension plan are being traded and creating revenues and expenses. Why does a food truck have a pension plan? No, it's not illegal, but it's unusual. We would put it in OCI. If the food truck is investing in derivatives, which are very unusual and actually fairly risky investments, then if they're gaining or losing money on those investments, that would be OCI as well. And finally, what if I am investing in foreign currency? I'm a food truck. I'm selling, I'm trying to think of the most normal food truck food imaginable. But I'm trying to avoid something that most readily comes to mind for a specific reason that I'll mention in a moment. Let's say I'm a food truck and I am selling salads, okay? Healthy salad food truck. Well, let's say I decide to take my earnings and invest it in euros because I think euros are going to increase in value. Okay, why would a salad food truck invest in euros? That's currency speculation. They can. It's not illegal. It's just unusual. Therefore, we would put gains or losses not in normal retained earnings, but in other comprehensive income. Now, why did I pause there for a moment? Because I was thinking Mexican food, right? Tacos, let's say, burritos, something like that. However, if I am the owner of a food truck that sells Mexican food in Houston to a primarily Mexican customer base, many of those food trucks actually do accept payment in pesos. And so if I was that food truck owner and I was accepting payment in pesos, Mexican pesos, let's say, then that wouldn't be considered unusual for my business. And I would probably put gains or losses from currency fluctuations. I would probably put those gains or losses in my normal income statement, and they would actually be in retained earnings because for me, I would be handling pesos on a regular basis. It would be part of my normal operations. I would not put them in OCI. But if I was selling salad to a non-Mexican population, or maybe a Mexican population, but people who are just paying by credit card or debit card or Venmo or Apple Pay or Google Pay, then if I went and invested my earnings in some type of currency, that would be unusual, and you would see the translation happening here. Okay, any questions about that? What I'm trying to get at is this has nothing to do with the profitability of what you are doing as a business. It has nothing directly to do with the nature of these transactions. It really has more to do with what would be unusual for you given the business that you are in. Questions about that? Okay. And by the way, this is another example where you're hopefully glimpsing the kinds of things that accountants actually do. Because accountants have no choice but to ask, okay, where is this money coming from and what are you investing in? And what is your primary purpose for being in business? And who is your customer base? And what is your product? In other words, to get the accounting right, accountants have to ask a lot of questions about what companies are actually doing, which puts the accountant in a great position to become a business advisor or business consultant, which is actually what I do primarily as an accountant. I primarily do management consulting. Okay, finally, treasury stock. Treasury stock is, well, it's not a contra asset and it's not a contra liability. It's a contra equity value account. Why? Because let's say we sold $55 worth of stock. That's where $55 comes from. Let's say we then repurchase the stock. Not all of it, but $6 worth. Well, if we originally sold $55 worth of stock, then we might have increased cash by 55, increased stock by 55. If we buy back $6 worth of that stock, we might credit cash by 6, debit stock by 6. Well, if we want to use a contra stock account, we wouldn't debit stock by 6. We might debit a contra stock account by 6. And the name for such contra stock accounts, and it's only used in situations where you previously sold stock and then you repurchased it. That contra stock account is called treasury stock. Questions? Okay. Finally, I did mention 18-2. As you can see, it is on my list. It is highlighted. But actually, if you look at 18-2, it's really just the same list that we were looking at previously. It's essentially just a list of other comprehensive income. It's the same items. He just gives you a few more footnotes. But 18-2 is actually, and actually even 18-1A is actually a different way of showing you 18-1. And honestly, what we have just done is walk through the chapter. Parts B and C, you know, as the author likes to do, gives you a few twists and turns, but this is fundamentally the entire chapter. Essentially, what I have done is given you a more conversational approach than I did in my video, which again, there is the expectation that you watch the video. So for instance, I don't think I gave the food truck example in the video that is more conversational. However, I do think that there is a lot of overlap between the video and my verbal conversation. And so hopefully over time, if this works, you'll be able to take fewer notes because you'll be able to rely on the video. That's my hope. We'll find out, I guess, on Tuesday with the quiz. Okay, let's take another breath. So we covered 2 different chapters in part, and we still have 7 minutes to spare. How about that? Any questions about chapter 18 so far? Any questions about our plans for Tuesday, which quiz-wise encompass chapters 11 and 18? Okay, in that case, going once, going twice, and we are done. Everyone have a great day, have a great weekend. I'll stick around a bit as usual.